You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey guys, welcome back to another episode of Market Champions. Today we've got Harris Kupperman, also known as Cuppy. He is, I believe, the manager of Praetorian Capital. And thank you so much for being on the podcast. He also publishes a weekly I'd say a summary of sort of what's gone on in the stock market that we call Cuppy's event-driven monitor. And I think that's something everyone should go subscribe. It's free. And thank you so much for being on the podcast. Awesome to have you.
Hey, thanks for having me on. I really do appreciate it.
Awesome. So I wanted to get started by talking a little bit about your background, how you got into finance and your journey to how you've gotten to where you are right now.
Yeah, sure thing. And just if the video is choppy, that's because I'm in Puerto Rico and it's about as good as it gets. So apologies. It mostly looks like I'm in slow motion at a disco. But as long as you can hear me, that's good enough. So I got into finance my senior year at boarding school in high school. It was the Asian financial crisis. And I was sitting there watching TV in the rec room, and I saw all these guys in suits running around like lunatics, losing fortunes. And it kind of made me think that if they're losing money, someone's got to make money. It's kind of zero sum. Mm-hmm. And I figured I'd be the guy who makes some money. And so I just started playing around with stocks. And, it took me a while to figure it out. It's not simple. You read a bunch of books, and they all tell you differing things to do. It's one of the few things out there where the different authorities often disagree with each other. Like, if you're doing heart surgery, it's all kind of agreed what you're going to do. And right. So it took a long time to figure it out, but I eventually figured it out. You buy cheap companies and with a catalyst, tailwind, and you kind of do a lot of nothing. And, it's actually an amazingly simple industry, this investing thing. It's all about not making mistakes because the winners, take care of everything. And if you choose well, you should have lots of winners. It's the mistakes that hold you back, and it's being disciplined not to make mistakes and unforced errors. I started a hedge fund my senior year of college. My dad had some drinking buddies, and I went around the golf club and picked up 25 here and 50 there, and I started a hedge fund. It was amazingly successful. And I've basically been in the markets my whole life now, and been very successful at this. It's kind of funny that I could play a big video game that puts, food and groceries on my table and pays my drinking bills and lets me go travel to funny places and interesting people. And I do it by playing a video game. I think it's great.
I like that last part of calling investing a video game that puts groceries on your table. And so I wanted to ask you, I wanted to start off by, talking about what's sort of your outlook overall in the market. And, one of the most common questions that I've gotten to ask you is, what are your thoughts on, energy and tankers and, coal and oil and that kind of space?
So I think there's a pending energy crisis. I think one of the most pivotal things that's happened in finance in the last few years is this week when two board members got booted at Exxon. Mm-hmm. You have CEOs who get paid a lot of money to basically babysit a corporation, and they like keeping their cushy jobs. And here you are where a CEO was producing oil and got kicked out by activists. I think that's going to put everyone else on notice that if you do your job and produce oil, you're going to get fired or, have your hands held. I mean, look at BP. They're in a slow motion liquidation where they've destroyed billions of shareholder capital and no one's fighting for that guy's job. He will eventually bankrupt the company and probably get a bonus. And, it's kind of, I think it's been a very interesting process. And, I think we're going to have a shortage of oil. And I think you're gonna have a shortage of a lot of basic materials. Commodity cycles are funny in that a lot of supply comes on at once, and then no new supply comes on for years because the commodity price is too low to bring supply. And unlike corn or wheat, where you can plant it and 6 months later you have more, a copper mine takes 15 years, start to finish. You have some that maybe are ready to go, but it's still 5 years to build it if you have your permits. I think you're going to have shortages of everything because you have massive government stimulus. And you have, so on the demand side, plus, population growth and everything else. And then on the supply side, you haven't really had any supply response for a very long time. And, I've been a little early in believing in the whole commodity world, but, I'm finally getting paid for it. In terms of coal, I assume it probably has the same attributes as all these other commodities. Coking coal goes into steel, thermal goes into electricity. I think all of these things are going to have shortages. Oddly, the thing I'm known for is tankers, and they won't have a shortage. There's been a lot of ordering in the last 6 months. There will be a lot of tankers, and there really hasn't been a lot of scrapping because interest rates are low and people are willing to do their special surveys and keep their vessels going. You need some sort of catalyst that forces scrapping or increases the demand side or something else. But I'm just not very optimistic on tankers. The share price is up because that kind of trades with energy, and I have no position, and I'm just not very optimistic right here, which is a shame because it's a sector I love. I do own one very large gas carrier called Dorian. Propane demand is it's rapidly increasing in Asia. But at the same time, they're ordering too many of those vessels as well. In the past 6 months, they've ordered a lot of them. I think there's gonna be a glut in 23. And so you're gonna have 1-2 more good years of earnings, but then it's gonna be a mess again, unless demand keeps growing. So no, there's too much supply of that, but there's not too much supply right now of new oil supply, copper, you name the commodity, there's real shortages. I mean, the only stuff that's too much of right now is like rare earth metals. There's going to be a glut of that. Maybe lithium too. I don't know.
Got it. And when you talk about tankers, sort of what would be the catalyst for you to jump back into the tanker trade? And what is it that actually drives tanker prices, like tanker stock prices?
Well, I mean, earnings drive pricing, and charter rates drive earnings, and supply and demand. It's like any other cyclical commodity. And you need either massive increases on the demand side or shrinkages on the supply side. And we know there's a lot of vessels on order right now, and that number keeps growing. And so you need, the demand side to pick up. And I don't know, I mean, it's going to pick up again because OPEC will go back to full production. And if they're going to ban oil, like oil drilling in the United States, like America's going to need more oil. But there's a lot of supply coming too. It's just, it doesn't line up. I mean, remember what I said a few minutes ago, this investing thing is very easy. When you look at something, it should be just, blindingly obvious. And if it's not, and you have to really think about it, you have to do a lot of research, then it's too hard. I put a lot of stuff in the too hard pile. You could call me lazy maybe, but I just know that if it's not obvious, within about 5 minutes of hearing a thesis, I could go, that sounds really good. Let's just check if it's factually accurate. But if it is, let's do it. And let's do it big. I don't do 1% positions really. I'm going to play 5 minimum, and I like to put on 10 and 15% positions. So you end up with 5 or 10 names in a book, so you can't make mistakes. But it also means it keeps you disciplined. But it also means that you're really going to chase your best ideas, and it has to be blindingly obvious. Like, all the stuff I put on the last year, it's just obvious. And tankers doesn't seem obvious. Tankers, this works. I don't know. It's too hard. I mean, will the price of oil be higher in 2 years? Well, yeah. You have the 3 largest oil companies in, the 3 largest publicly owned oil companies, Shell, BP, Exxon, and now Chevron, all basically have been told by different authorities to stop doing their business. Like, what do you think is going to happen when they can't do their business anymore? There's going to be a shortage. And what do you think happens if you stimulate too much? demand's going to pick up. Right now, the demand pickup is lagging in jet fuel because people aren't flying. Well, that's going to be fixed in 6 more months, and then there really will be a problem. I think you could buy oil futures. I bought, out in the curve, I bought the 25s. They trade at 53. I mean, the curve is being weighed down by producer hedging, but it's also people saying, every time it's gotten into the 60s, there's been a wall of selling from shale because shale ramps up. My view is maybe it doesn't this time, but even if it does, I feel like I'm risking $5 or $10 and maybe make 100. It's the sort of trade I like. I like obvious stuff like that.
Got it. And in your last letter, I believe you talked about SandRidge, dollar ST. So could you sort of give us a brief overview of what you're looking there and sort of an update on what you're thinking right now?
Well, SandRidge is a company in decline. They're not drilling right now. They mainly own mid-con assets. They have about $2 a share of net cash. It's a $5 stock. And they're producing, depending where you think the strip is going to be, they're producing somewhere between 25 and, where today's strip is more like 50 cents a quarter. So, in 2 years, the whole balance sheet's cash, and, those reserves will trail off over a long period of time. You have a few $100 million of PDP, and the enterprise value is 60, 70 million right now. It just seems mispriced. I'm not going to tell you the mislime is a dream asset. It's not. What I've done a lot in my career is looked at B- assets that are valued like Ds. What I found is that the A's, the A+, the A-, they'll all have premium valuations, and there's a real drop-off in the mid Bs, B+ to B-, where it's valued like a D, and a lot of them are kind of like B-. I came into this stock, I bought most of mine at $1 or even a little less than $1, though I had a starter position from higher. At the time, the thesis was they had an office building and they had a lot of valuable assets. And they sold the office building for more than the market cap at the time when I purchased it. They had no debt at the time. So I literally bought producing wells, quite a lot of them, with a lot of production for a negative value. I mean, I'll do that all day, every day, especially if I'm bullish oil. They gave the thing away. They ended up selling one of the other assets. They fire sold it, much like they fire sold the office building. I think if they'd waited a little longer in the cycle, they would have gotten $4 or $5 a share as opposed to the $2 a share of cash they got. But I came into it for $1. I'm not upset. I thought I was going to get 15 or 20 back, and I'm probably going to get, more than I paid for it back. I don't know how much I'm going to get, but I'm going to get, it's been good for me. It's like a 5%. I'm not that upset. But it's a liquidation. And, it is, if your view of energy pricing is that the current strip's the right strip, it's probably, a few dollars from fairly valued. If you think pricing goes up, obviously has headroom. So I wouldn't say, go in and invest in this here at 5. I don't think that's the right move. But, from $1, why not?
Absolutely. And, what are your thoughts on coal companies? And I believe the specific one that was mentioned was BTU. What are your thoughts when it comes to coal and coal companies overall? Do you remain bullish, or do you see any opportunities there?
Well, structurally, I'm bullish. I think, demand in the U.S. for thermal might decline. It might actually increase this year, which would be an outlier year and a trend change. But I think global demand is going to increase for thermal and coking. And so you have assets that are priced like dying assets, and they shouldn't be. Of course, there's problems. A lot of America's coal production doesn't have port access, or it's expensive to get it to port. The Australians have a fight with the Chinese. They're not getting premium pricing. There's problems. It's like everything, there's problems. But if you're selective and you think through it, I think there's a lot of real gems out here. I was, I guess, early, like I always am, in some of the coal names, and I had a multi-bagger in quite a few of them, and I got out. I've missed a lot of the recent run, but I made a lot. It was good for me. I think it keeps going. I think there's better places to make money, though. But I do think coal pricing probably stays here or goes higher. And, a lot of these companies, even if it just stays here and they're valued as continuing assets or even slow decay assets, but not as slow as the market's pricing them in on an NPV basis, even with a high discount rate, I think they're undervalued. I think there's money to be made. It's the problem is I think the market's going to give these assets very low multiples. And so it's going to be hard to make money outside of dividends. And there's other assets you could buy where the market's going to give you a multiple expansion, which lets you accelerate the crystallization of value because you get a multiple on it rather than waiting for a coal company to liquidate over 20 years. I just think there's better things to do.
Right, got it. So another sort of topic that I wanted to focus on was JOE, the St. Joe Company, which basically owns a lot of land in Florida. So, what are your further thoughts on JOE, and how many buildable lots will they ultimately have, and how much do you think they're going to make, per lot?
So Joe is my largest position. I've never sold a share. I've bought some more actually. Bought him in the 40s, and I might have even paid in the 50s. I think it's the most undervalued large cap stock. $2 billion is large cap in my world. But I think it trades at a large discount to net asset value. I think that the business is rapidly growing. It was always a land bank that everyone kind of knew was undervalued, but nothing was happening, and cheap stocks stayed cheap for decades. But if you look at Q1, they grew revenue 122%, which is pretty rapid growth in my book. I mean, that's faster than most of the SaaS companies that have silly multiples. These guys are also profitable, very profitable. I don't really know how you value Joe. I mean, I think you've got multiple demographic trends. You have the Florida for taxes, you have the retirement trend to Florida, you have people leaving cities. You have an air base there that's got a big government contract. You have all these different trends in motion simultaneously that I'm playing from a macro standpoint, and I found the cheapest way to play it. I mean, I'm a trends guy. I like finding trends, and then I try to figure out how to play it. How do I get exposure where I have levered exposure without taking on a levered balance sheet? Because that's how you get hurt. And so Joe was the best way I found to play a lot of these societal demographic trends in America. And I think it should trade at a premium to NAV. I think it should trade at 2 or 3 times NAV. And that gets me to a share price that's a couple $100 today. And that NAV is probably growing 20 to 30% a year. And so, I just think it's a great asset to own. It's a low risk asset in my mind, just because there's no net debt. And I'm really excited to own it. I think the best is yet to come there. What was the other half of your question?
Sort of, how many buildable lots do you think they're going to have, and how much?
So they have a Bay Walton sector plan that's approved, and it's about 170,000 lots. They're going to develop about 1,000 lots this year. I think when they get to full stride, which is probably 5 years out, I think they'll be doing about 3,000 lots a year, which would give you over a 50-year duration of this asset, and that doesn't include all the infill of commercial. I assume in 50 years I'm long since retired, but people are worried, they're going to sell the best land and it's over. And what we've learned is that the worst land is very valuable. They have a new Margaritaville development. There was a lottery system to see who was able to buy the first tranche of units that would be delivered next year. It was many times oversubscribed. I think it was like 10. I think 1 out of 10 people got a lottery where they won the lottery to even be allowed to purchase a unit. So that's how it shows you what the demand is. But those lots, when you do the math on them, those are the worst lots. Those are the lots that Einhorn said was worthless swampland. And what we've learned is that those lots are worth a few $100,000. That those acres are worth a few $100,000 each, probably $500,000 to $1 million each. And so when you start doing the math backwards, where the worst land is worth that, you start saying, what's the best land worth? And I think it's very wrong to just take the number of acres and multiply it by a number. But right now you're basically getting all this land for very little more than the commercial property that's already developed, and it just seems wrong also. But they will produce 170,000. It'll be effectively an annuity in my world because it's a 50-year annuity. But it'll grow probably 30 to 50% a year. I mean, 122, I wish we did that every year. But law of large numbers will catch up to them. But I just think it's a rapidly growing company that trades at a single-digit earnings multiple or cash flow multiple. And it just seems like the wrong price here. I mean, I think a company growing this fast that should trade at NAV or a premium. And that's still a multi-bagger from here, just getting to NAV. And like I said, I think it's a premium.
Got it. And that makes a lot of sense. And one of the stocks that you mentioned in quite a few recent KEDMs is LEE, which is which is basically a newspaper company. And one thing that LEE has done is there's sort of this rapid growth and this rapid shift towards digitization of media. And so what are your thoughts on what's causing the shift towards this digitization of news and of news media overall?
So, I mean, I think I know why news media is going digital. I mean, when I was a kid, we'd have a newspaper in the house and you'd read it, you have to fold it, and it'd be messy in the morning. You'd be sitting there. My dad would send he'd be sitting there eating his cereal. We'd be, at like 10 minutes before I go to school, and you'd have this thing, you're folding it and unfolding it. It's getting like cereal all over the place, and your hands are black with newsprint. It's a dumb product. What they've done with digital is they've developed apps. It took these aren't tech people, these are newspaper people. So it took them like 15 years after the world started using apps for them to finally do it. But they created these apps that let you search for articles. It has embedded video. It's genuinely entertaining. It links back to old articles. Newspapers are really funny because what they tried to do is compete online with advertising. So you could either get the physical copy, you paid them, or you could get it totally free, but it was web-based. And so they were competing with themselves, and they literally were bleeding customers. People said, why am I paying $50 a month for a newspaper? It's totally free. I just got to click a banner ad and I don't have to pay it. And so they were literally competing with themselves. It was so dumb. And they did it for 15 years. And I mean, I followed these companies because they were always like 5 times cash flow, but the cash flow was declining like 20% a year as they competed with themselves and gave the product away for free. It was so stupid. And the New York Times was the first ones to realize, just because they almost went bankrupt, that they can't compete with themselves. They put a paywall up. And they basically had the proof of concept for the industry that people will pay for news. And as more publications have put paywalls up, it's become more socially accepted that you pay for news if you want it. And it's allowed the newspapers to reinvest in the digital apparatus that delivers it, but also lets the newspapers invest in content. When you look at newspaper companies, they've spent, it's really a phenomenal business because the incremental dollar comes at a very high margin. But when you have a printing press with all these employees running around printing paper, chopping down trees, and then they have to deliver it at 5 in the morning, it's, they're all unionized. You got like healthcare benefits. It's all this messy industry where you can put it digital and you have 99% incremental margins. And it's a phenomenal business. People haven't realized this though, because the revenue lines have been declining for years and years because digital was this, 1-2% of the business that was growing very fast, and print was declining. And we're at the point now, and I own a basket of these. I own about a basket of these in multiple countries, but depending on which one you're looking at, the print is declining, but it's kind of looks like more like a J or an L, where the decline rate slowly like this. Because anyone who's going to cancel is now canceled, and people like my parents will never cancel. And so that's kind of declined out. At the same time, digital is growing, depending on who you're looking at, between 20 and 50% a year. And so you have a rapidly growing digital business where in many cases, you're at the 20 to 40% of revenue that's digital, which means, since the margins are so much better in digital, you're looking at on an EBIT basis, even if you reallocate the SGA, these businesses are more than 50% digital native businesses now, and they're growing. Quite a few of them are growing net subscribers. They're growing subscription revenue. They're not growing revenue because print's a much higher price point. Plus, advertising hasn't really come back yet after COVID. But you have a growing digital native business that trades at like 2 times earnings, 3 times earnings. It seems wrong. It should be like I don't know, what's a digital native business with pricing power worth? The SaaS companies trade at like 30 times sales, and these things trade at like 3 times cash flow. It's just like the wrong price. And I don't want to say, Lee is the best one or anything, because it probably isn't. But I have a basket of these, and I don't really understand it that well. But as more of these guys put paywalls up, and you can't just go, it used to be, oh, the New York Times has a paywall. Well, I'll just get the news somewhere else. I get the news Washington Post. I guess the news, Fox. As everyone has paywalls, you're forced to, pay. And I mean, how much does it cost? It's like $8 a month. Like if I don't read it that month, I don't really cry. It's very different from, $50 a month. And if you don't read it, they start piling up in your lawn, So anyway, I own a basket of these. I really like the sector. I think it's super exciting. All these companies have flaws. They have, pension, liabilities, and they have environmental liabilities, and they have lots of debt. And I don't think any of the management teams are A+. I don't even think a lot of them are B. But, in the end, people want news, and I think there's been a real loss of trust, in the last few years at the national level. If you look at it, the growth rates of the New York Times, you can just look on like SimilarWeb or Google. It's really stopped, like page views stopped growing because people got sick of everything's political, everything is, political, or it's about Trump, or it's woke, or you can look on the right, in terms of political, and it's all about Trump, and it's all about, all the issues the right wants. And I think there's a lot of people that just want to get the news, tell me what happened yesterday, or tell me what happened an hour ago, because that's the great thing about a digital native product. It just pops up on your cell phone as the story gets filed. Tell me what happened, tell me why I care, and give me a couple pictures in color, have a video I can click to, and don't tell me what I'm supposed to think about it. And especially for local coverage, like, why is the highway blocked? What happened? Like, tell me, is there an accident? I want to know. I'm just curious. Like, tell me, and so I think there's been a sort of a change in psychology amongst people that they just got sick of the national level, and they've kind of gone to, more local news. And we've seen this in a lot of countries. You look at, Spanish papers, they're all growing, 100% a year on the digital side. People got sick of listening to US politics, and they want to talk about their own countries, like El País. It's growing fast. Look at any one of these countries. And I just think there's been a real change where the big national guys, the growth rate's slowing, and, the more regional guys, or the, national guys in other countries are growing fast again. I think it's a cool trend. The UK is growing fast. Like all these countries are growing fast. Anyway, it's a sector I followed a lot, and I followed it for about 10 years as it hurtled towards bankruptcy. And in the last year or so, you got to a world where, you have these like two lines on a chart where like you have, print decaying and you have digital growing. And a lot of these, the lines will theoretically cross in the next, couple of quarters, or I hope they will.
Got it. And another one of your sort of famous views is that of Project Zimbabwe. And so what are your thoughts on, say, gold and precious metals, and, gold and precious metal miners as a whole?
So I think gold and precious metals will do very well. I think everyone should own some physical. It's not investment advice, but I own a lot of physical. I think everyone should have some. Will gold go up if they keep printing money? Yes, absolutely. Will it track the Fed's balance sheet, or some metric that historically it's tracked? Like, I don't know. It tends to lead and lag over long periods of time, but over decades, it tends to track the Fed's balance sheet, or it tracks, the cost of production, which I think is the more relevant factor of the global all-in cost of production. I think it's an asset that'll do well. Gold miners, not as interested in. You have to remember, gold mining is a truly terrible business. You have big trucks moving lots of dirt around, which is energy intensive, it's people intensive, it's steel intensive, you have chemical reagents. In my experience, these things don't line up. The price of gold goes up, but the price of diesel goes up faster, and the margins get compressed. I remember the last cycle, all these projects were supposed to be 500 million, and they ended up costing, $1.5 billion, because their cost overruns, the price of steel went up. And, it's just like a terrible, terrible business. And then you always have the country you're in saying, why are these guys taking our gold? And, they'll change the tax rate on you, or they'll, do something screwed up. It's just a terrible business, asset heavy, terrible business. And, because you have all these fixed costs, if the price of gold drops, you really get hurt. Or if, your mine stops producing because a piece of machinery breaks, and there's so many pieces of machinery, there's always something broken. Think of it this way. The price of gold, I bought my physical gold. I don't think I ever paid over 600. I bought most of it in the 300s. I caught the turn, and that was, almost 20 years ago. And at the time, I think GDX, it didn't exist then. But when GDX first listed, I think it listed at like 40, $50. And here we are, gold is 1900. It's like a six bagger, and GDX is the same price. I think it tells you something. The greatest, you had this like 20-year bull run in gold, and the industry as a whole has like created zero value. And then, you also have survivorship bias, built in there. I have a lot of experience losing money at gold mining, so I can tell you about all the ones that didn't work.
Right.
I don't think that's the way to play. If you're bullish inflation, that's probably
Number one catalyst.
No, if you have a view that the price of gold is going to go up faster than the inputs, then it's the right way to play it. If you have a view, if you understand geology or mineralogy or mine economics, you could probably choose individual stocks and do very well. I'm a generalist, and I try not to be too smart about anything, and I just look at history and trends. And in my experience, if you're in a sector that's terrible, that has a long history of being terrible, that doesn't mean you can't play the sine curve. It seems that every 2 or 3 years, GDX goes from like 20 to 50 back to 20. Like you can play that, but is this the thing you want to buy to play inflation? I think it's like the last thing I want to own.
Got it. So now I wanted to move and talk a little bit more about your process as a whole. So first I wanted to start off by asking you, what is your framework or what is your process for identifying more contrarian kind of investments or trades? So, Argentinian banks, thermal coal, Playboy, was still SPAC. We just talked about LEE, so newspapers are not a very sexy business, but you still own quite a bit. So what is your process or framework for identifying these overall contrarian trades?
Well, you start by looking for what's down a lot and hated a lot. It's I'm looking usually at multi-year lows. I'm looking at it on a sector basis. I'm usually looking for stuff that people hate. People hate it because my friends call me up and they remind me how much money they've lost. There's a lot of cheap sectors out there. We're tracking dozens of them at our firm. And the issue is, what's the catalyst to unlock it? Because, a cheap company that is destroying capital ought to trade at a very low price because it'll be expected to lose money next year or destroy capital next year. And so you need a trend change. You need something that changes it. And that's the most important thing I look for. What's changing? And, if you can get these trends right and get these inflections right, you can make a lot of money. But you have to get the what's changing question right. And I think a lot of people miss that. They look at something cheap and they say, well, doesn't the market understand it's cheap? And it's like, yeah, the market knows it's cheap, but it's destroying capital, or it's earning negligible returns on its capital, or even it's earning some return on its capital, but it's not growing. You need the market to think, hey, if I don't buy this today, tomorrow the share price is higher. You need that FOMO to kick in at a small level to actually make the stock go up. Otherwise, I could look at it and say, okay, great, the dividend's 10 cents a quarter, it'll be 11 cents next year. Like, I don't care. I'm in this to find multi-baggers. You need something where you say, this company, they're making 10 cents a quarter and they're paying it all out. I think they make $2 next year. You have that shocking moment, even with newspapers. What changed is that digital went from, 5% of revenue and it's been growing, and suddenly it's coming up on 20 and 30% of revenue. And you can look at it and say, in 8 quarters or 10 quarters, I think it's half. And then suddenly it becomes a primary digital asset and it gets revalued. And or you say, hey, it's actually growing, on the revenue, the cash flow line, whatever it is, but there's growth. And so there's a lot of hated assets. I can name you lots of them. There's whole countries that are hated. But you need something that's changing, and that's the important thing. Finding things everyone hates is easy. I mean, there's ways to scan for, price to book, or, assets that are down a lot. Right now everyone hates emerging markets, which I think is crazy. They're the cheapest they've been in my entire career. Meanwhile, U.S. assets are the most overvalued, and in an inflationary environment, emerging markets tend to be commodity exporters, and they should do very well. As a basket, and you could dig down to individual countries.
When you say emerging markets, so what are you referring to? Because the first thing that most people think of is sort of the EEM ETF, which is up quite a lot over, say, the last year or so. So when you say emerging markets, could you be a little more specific?
I would go next tier down. I don't want to say, I guess, too much about individual countries, but like take a place like Mexico. There's been dramatic dispersion of returns amongst Mexican assets. Some have bounced back really fast and some haven't. It is opportunity there, whereas before it all kind of tracked the index more or less. But I think you can look at almost all of LATAM's been beaten down. I mean, obviously Africa is ridiculously cheap right now. You have to open up accounts in the home countries. Custody is difficult. There's stuff to do, but a lot of these markets, Southeast Asia, I think is very cheap. Once again, you have to be selective. I wouldn't go buy an index, because the index tends to be the biggest couple of companies in each of these markets, and those tend to have Western valuations, because you have institutional money and institutional fund flows.
Mm-hmm.
And so the Coca-Cola subsidiary in Mexico is probably valued almost the same as Coca-Cola subsidiary in the US, or the one in Ghana. That's not what you want. You want that second tier down, where there's not the same sort of liquidity and it's not in the ETF. So it's valued at a local market level. And, I'm no expert on this stuff. I don't even pretend to be an expert. I have friends who are experts, and they're telling me how cheap it is. And they keep showing me stocks that are like 10% dividend yields growing fast at like a third of book value, and 6 times earnings and stuff. And you're just like, wow, that's really cheap. And I think, money printing should help a lot of these emerging markets, frontier markets. It reminds me a lot of the day before they came out with the COVID vaccine in November. Mm-hmm. I remember everyone crying and saying, value is never going to work. Value's been terrible for 10 years. Value's awful. Let's go buy fraud. Let's go buy Ponzi's. I mean, I used to joke about that too, yet I mostly own value. And then one day value started working, they flipped the switch, and value hasn't stopped working. And a lot of, the stuff that I've been following is up like 2, 3, 4 times in like 6 months. And it's a really dramatic revaluation. And, everyone's saying frontier markets won't work. There's no liquidity, there's no, bid, institutional money can't buy it because of liquidity or because of compliance, and everyone makes excuses why they can't own it. And then one day they go, wow, that was a 5-bagger in plain sight. We missed it. So no, I think there's opportunity there. And there's a lot of places with opportunity right now. We've done more outside of the US than I have in a very long time. And we tend to be sticking to like the biggest 1 or 2 companies in each of these countries. But we've done, look at I have no position now, but like even France, in the US, there's no cars for car rentals. Europe has no cars because all the car rental companies had a margin call when COVID started. They liquidated their fleets to pay down the revolver. And now there's no chips, so there's no new cars coming. And everyone's starting to travel again. Lease rates in the US are at ridiculous highs. Used vehicle prices are at ridiculous highs. Avis is at ridiculous highs. Look at the stock; it's at new all-time highs. It's crazy. Right. Even though they had a year of losses during COVID, and so you have a company like Eurocar in France that just went through a pretty messy restructuring where everyone got diluted badly. And the stock's not up really too much. I bought it when it came out of the restructuring, and I sold it and made like 30% in like a month. I probably should have held it, honestly. I just wanted the capital for someone else. But there's just all this interesting stuff. And these are that's a €1 billion company, €1.5 billion company. trading on a major OECD exchange. It's just been left for dead. This is just so much opportunity right now. There's so much cool stuff to do. And the thing we're doing the most of is looking at what's worked in the US on the COVID reopening trades, and then going to markets where they've been slow on the reopening and putting the same trade on. So like cars, hotels, casinos, like if it worked in America, it's going to work in another country that hasn't released restrictions. And man, it's been clockwork. It's easy. I'm embarrassed how easy it's been. It's really I would expect the markets to be smarter at this stuff. They shouldn't be like this. And I'm reminded that for a few years it was really hard. It was me trading against Citadel all day, and like the ring against Tyson. And now everyone's like dazed and confused. Trading desks don't exist at big banks, so there's a lack of communication. Everyone's in their gym shorts at home, and stuff slips through the cracks. It's great.
Almost free money at this point.
Almost.
So when you start, evaluating an investment idea, how do you go? What's sort of your process after, actually finding an idea? Do you jump straight to the financial statements? Do you look at sentiment? Do you look at, what the business actually is? How do you go about evaluating ideas after you've found it?
So I'm doing I do two things. Okay, I do small cap growth, which is really what I like doing. Something like St. Joe would be a small cap growth company with, a macro tailwind, but it's small cap growth. I'm gonna own it for a long time. It's gonna compound. It's great. Unfortunately, it's just not a lot of those that are cheap these days. You don't see companies growing the top line over 100%, trading for single digit cash flow. It just doesn't exist. And that's single digit out a few years, about 2 years. 10 years ago, it existed a lot. And so we've been doing a lot more of the inflection side where you're not as focused on the business quality, you're not as focused on the management quality. The moat doesn't really matter because it tends to be a cyclical business or a business with messy financials or a business with earnings volatility that Wall Street can't put a linear path to. And so you're not so focused on the research side of the individual company. Obviously, you want to make sure what the real cap structure is, like what dilutables are outstanding. Is the debt termed out? Are the people running it criminals? You like usual background stuff. But I'm more focused on what the trend is and why I think the trend is inflecting and how confident I am that it's inflecting. And then also what my entry place is. And do I have enough downside protection that if I totally bomb the thesis, just get it totally wrong, will I get my money back? That's either, balance sheet strength or earnings power or something else. I want to get there early, right at the inflection before the stocks moved up. Usually these things build big bases over a few years. But I want to, catch that inflection and not take a lot of risk. I think you can look at this perfectly with the tankers. I caught an inflection where IMO 2020 was going to force a bunch of older vessels to get scrapped or at least be less economic. There was almost no new ordering, and it was a 10-year bear market. And I bought the 1 quarter before, the first quarter with cash flow effectively in 10 years. They've been wasting assets. And I bought it at the inflection, and the companies had 4 consecutive quarters of increasing cash flow each quarter. And then, the stocks went up quite a lot. They still weren't at NAV. They're still at discounts to NAV, but they doubled or in some cases tripled because I bought these things at less than half a NAV. And then COVID came and it destroyed my thesis. And, we had a period of time where we had this super contango and the companies made the most money they'll probably ever make in my career. And then the super contango ended and my thesis died. And, you had a world where OPEC wasn't exporting as much and there was no demand for tankers and the stocks collapsed and I mostly got my money back. Net, I made some money on the trade. I had been up a lot and I made some money because I bought the turn. And, that's the goal of what I'm trying to do is catch the turn and know what my downside risk is. And when the thesis stops working, get the hell out. But you should be able to do this inflection thing and get it wrong a lot because you're going to get, a third, half of these wrong and get your money back. And if you get it right and you make a few times your money, it's going to be very good for you.
Right, got it.
So on the valuation side, I really want to know what my downside is. when you build a model, and you can build a model for any of these companies, you're going to have your best case, your mid case, your worst case, and you're going to extrapolate it out 2 or 3 years until you get to mid-stride earnings, wherever that is, not peak earnings. And the variance between the three is going to be so wide that your base case, your best case, your worst case, it's not going to mean anything in valuation. So, I mean, you build the model just to figure out if there's something you're not understanding in terms of where the leverage points are. Will SGA increase with revenue? By what ratio? Make sure that you understand, what the drivers are of the business from an economic standpoint. But outside of that, like it doesn't do anything for me, really. We just have it, and we always look back at it. We're like, wow, we were so wrong. We were so wrong. But we made so much money anyway, And that's sometimes we're too conservative, and sometimes we're too aggressive. But we're always so wrong. It's just like it's not a useful exercise, I think.
So you value purely to ensure that you stay conservative enough, and then most of the time your valuation overall usually tends to be wrong, but at the end of the day you still end up making money.
Yeah, look, if you get the thesis right, even if management does a terrible job, I mean, even if they steal from you, you're probably going to do okay. And if you get the thesis wrong, it doesn't matter what management does. So get the thesis right. That's the whole point.
Mm-hmm. Yeah, got it. And sort of the last part of the podcast, I wanted to talk a little bit about portfolio construction. And so how do you go about actually sizing these ideas? Remember, earlier you just said that you don't do 1%, 2% positions, you take bigger bets. So how do you go about actually sizing these ideas?
So I have a view that you want really concentrated positions. It kind of focuses the mind. Once you get more than about 10 names, you kind of just track the index, which no one's paying you a bunch of money to go do that. I mean, your goal is to dramatically beat the index. And so you're going to run a concentrated book. I have a cap at 20% on any one name. That's just prudence. Otherwise, I would just have a whole Joe fund and nothing else. But it would be, I don't like anything below 5 because I find that you don't focus on it. And then when something happens, you miss it. I go out with my guys, we talk stocks, and those 1% positions you never talk about. So then when something happens and changes, you're always blindsided. And, what's the point? I've actually seen very few of those work for me, whereas the big ones usually work. And so I'd rather just do those. So I don't usually do less than 5% positions. I like to put it in the 10 to 15 range. And I like to have my 5 biggest names be 70, 80% of the book. And, because it focuses the mind so much and because you concentrate so much, you really have no margin for error. You can't make mistakes. You can get the trade wrong and get your money back. You can't have one of these go down 50 because you missed something. Like when that happens, like it's going to wreck your whole year. And, if 2 of your 5 go wrong, like it's a disaster. So it really focuses you. It forces you to think downside the whole time. What's my downside? It's every day. It's what I'm asking myself. And I just think it's a better way to do it. I think the biggest risk when you're that concentrated is correlations between the portfolio that you don't understand. Obviously you say, I have only energy stocks. Like I have, 3 different energy companies. So it's all tied to energy. Like that's obvious, or I have nat gas and coal. It's all tied together. The correlations get confused when, some big fund happens to have 3 of your 5 names and then they get liquidated. It always happens. It happens about once every other year. It's $1 billion fund. And I'm like, how did he own 3 of my 5 names? And you'll have it like a down 20 month, and you'll eventually, pick over his carcass because you'll buy the blocks on the cheap, and it'll be good for you. But those sort of correlations you can't predict. Or you'll have a correlation where right now I'm very long inflation. Most of the things I own do well in an inflationary environment, or at least an environment where the economy is growing. There's a lot of liquidity. Where basic industrials, where housing, where commodity sensitive, I guess. And there was going to be this day where Jay Powell has a press conference and he says, hey, wait a second, inflation's going crazy. And we're going to, stop with the QE. We might even QT a bit. And I think I'm going to have it down 30 like that day. And either you recognize it like I do and say, okay, I'm going to have it down 30 and that's going to be a really terrible day. But I think looking at a few years, I like what I own. Or you say, wow, I can't afford to have it down 30. It's not how my portfolio has been sold to my clients, or I can't stomach that if it's my personal money. And then, in that sort of case, you look at it and try to figure out what your correlations are and how you're going to get hurt. I don't think people think enough about it in that sort of sense.
Yeah.
Things are oddly correlated, and you don't realize it until the world ends or something weird happens.
I agree. And do you ever, does the sizing ever depend on the type of play it is? So in your KEDM, you split it up into so many different categories. You've got spinners, you've got M&A, you've got fallen angels, and does your sizing or does your position, how much you allocate, does that depend on what kind of play it is, or does it purely depend on how well you know the trade or how confident or what your prediction is?
So let's talk about Kedem kind of separately. So Kedem is event-driven. This is very different from the position trading. Most of my book is position trading. It's stuff I'm going to own for a couple quarters, couple years. Right. Kedem can be anything from a few days to a few months, rarely more than a month or two. The trick with that really is that the odds are in your favor and you diversify a lot. Mm-hmm. I don't usually take very large positions, not because I don't believe in them, but I know that it's all random. And because you're not doing real deep fundamental analysis, and you don't really know the companies that well, it's usually something technical, you often get surprised with a press release and the stock's down 20%. And so you don't really want to really size it up that much. The trick is to have a diversified book of these, play the odds in your favor, and never have any one position move too dramatically to the downside where it actually moves your numbers. Sometimes to the upside, you get, explosive moves, but it's a very different strategy. In a world with high volatility, it's been a very lucrative strategy, quite honestly. Event-driven's done better in the last 12 months or 15 months than it's done in many years because, the VIX was 12 for like 5 years. I hope to keep playing these. It's slowed down a little lately, but there's a lot of stuff that is pending. And for people who don't know what Kedem is, it's an event-driven monitor I built called Cuppy's Event-Driven Monitor. It's probably not the best name, but we track about 25 strategies, mainly corporate events, but we also have some fund flow events. Our view is that inflections happen when something happens at a corporate level. And those inflections can be short-term or they can be very long-term. And we're tracking all of this mainly because I wanted it for myself. I was missing too much stuff. And so I built this thing for my own needs. Some friends of mine wanted it. And I realized very quickly that I need more manpower to track another 20 or so strategies I want to track. And I don't know, it'd be nice if someone else helped pay for it. So we're going to have it be a subscription product. I hope you subscribe. Right now it's still free. I highly recommend everyone sign up because it's free. Go to kedm.com. But eventually, we'll put a paywall down to hire some guys and hopefully keep making the product better. I know it's helped me a ton to flag stuff and not miss stuff, and I've made a lot of money out of it. And I hope everyone else can make money out of it too. No one's built something like this, otherwise we would have just paid for someone else's product. I never set out in my life to be in the publishing business.
Right.
But anyway, I'm really proud of what we've produced. Well, actually, it's my analysts. They've produced it. I've done very little. I write some comments each week. But I tend to flag about the 10 or so most interesting things that I think are worth looking at. So try to make it less time intense because there is 100 pages of data.
Yeah, and I think it's amazing as well. So,
hey, thank you, appreciate that.
So, basically, the last question I want to ask was, so when you think about entries and exits, so how do you actually decide when to enter, when to exit? Do you use some form of technical analysis? Do you just enter when there's a catalyst and don't pay any attention to say technicals? Or how do you go about thinking about that?
So I'm not really a chart guy. I think charts show you where you are in the narrative, but in the end, if I think it's cheap, I want to own it. Usually, growth companies are usually lower left to upper right, and you're just jumping on a freight train. I'm not buying breakouts or anything crazy like that because it means you're paying higher. I want to buy it, as cheap as possible. On the inflection stuff, I found that sometimes the inflection is really obvious to me, but it's not obvious to the market yet. And so if something's still making new lows, I want to wait. I want to buy it when it's making that saucer bottom or it's starting to show a little bit of strength. That's when you want to buy it. The market will tell you when it's time to buy it. But in the end, I'm just trying to buy it as cheap as I can without it getting cheaper. On the exit, it gets to fair value or where I think fair value is, or I find something better I need the capital for, and I reallocate. I'm not really a chart guy on the way out either. Now, I will say that if you bought my winners and held about 3 more months, you'd probably have the best track record in finance. I always sell too soon, but that's fine. And so, I don't really think about it too much. I usually exit a position when it gets to fairly valued, overvalued, or something's happened to the thesis that's changed the thesis. Management made an acquisition that makes no sense, or something's happened to the sector that I'm less excited. It's usually pretty obvious when to get out, and much like it's kind of obvious when to get in. I don't focus too much on the charts. That's just not who I am. I just don't want to buy something that's just making new lows every day because that's just how you get hurt.
Any closing thoughts?
No, I mean, I see a lot of people make our business way too complicated. They overthink things. They build giant models. They go deep into the financials looking for funny footnotes. I mean, that's all great. I mean, it adds to everyone's collective knowledge. But in the end, it should be so amazingly obvious. Look, the most recent position I bought, Kedem flagged it for me. My monitor actually flagged it. I made it a bigger than 10% position. It's a company called Valaris. They produce, they have the world's largest fleet of offshore drill rigs. If you think the price of oil is going higher, there'll be more drilling offshore probably, maybe, I don't know. But if there's no more drilling offshore, I don't think I get hurt. They came out of bankruptcy with $100 million of net cash. They impaired the fleet quite a lot, but it's trading at a 1.5 billion, or where I bought it at 21. It was trading at a 1.5 billion enterprise value. The fleet at replacement cost is north of 15 billion, and so I'm paying 10 cents on the dollar for a young-ish fleet. Normally, these fleets they go obsolete because you have a next generation drill rig, and then 7 years later, the next generation comes and you're obsolete. And I don't see anyone spending $1 billion on an ultra deep water, harsh environment rig right now. So, you probably have a decent runway with this. And if it trades up to, maybe not replacement cost, but it trades up to depreciated value after impairments, it's a 10 billion EV. That's a 7-bagger. If it trades up to, half of that, it's a 3-bagger. It's cash flow positive. I mean, it was flagged when it came out of bankruptcy. There was no corporate deck yet. I looked at what the fleet was. I know a bit about the sector. I looked at where Transocean was valued, and I said this thing would be $50 to $100 if it's trading where Transocean is. It's at 21. There's no net. There's net cash. It's cash flow positive. You don't have to be a rocket scientist to know what it was. Within about 5 minutes, we already had buy tickets in. We were trying to buy as much as we can because we didn't think it would last too long. I'm amazed it lasted almost a week. we bought a lot. But it has to be so obvious like that. I'm buying steel at 10 cents on the dollar. That's profitable. And in a sector that I'm bullish on, where I think things already are getting incrementally better in offshore. Utilization is going up for almost a year now. You're at inflection, but because Valaris came out of bankruptcy, and bankruptcy is one of those funny things where most of the creditors end up with equity. They don't really want equity. It's not what they're in the business to do. And so they sell it. And in this case, I mean, they had bonds. And then in the time since they bought the bonds, ESG became a real, big thing. And a lot of these funds really had to get it off their book in a hurry. So they were selling you something that, is probably worth a lot more than today's quote at, a much lower price. And I looked at it, like just the basic facts, and thought about it for about 90 seconds. We started buying a lot. And then we scrambled for 2 or 3 days to learn, get up to speed very fast in the industry and basically figure out what we were missing, because it was too cheap. We thought we were missing something. Maybe we are. I don't know. But it has to be so obvious like that, where you can put the whole thing on a napkin. And I just think people should step back and make things obvious. It really should be obvious. I don't think of that often, or I don't think that hard. I just read a lot and try to put a lot of information in my brain. But it's mostly just to have enough knowledge to reject really, dangerous stuff. It's not really to track down the next idea. I don't know. Sorry, I'm rambling. It's a Friday.
Awesome. Thank you so much for being on the podcast. It was awesome having you.
Hey, happy to be on. I really appreciate you inviting me. Thank you.